you can't sell an investment property and then buy a residential vacation home if it's going to be used primarily by you. You'd need to be renting it out the majority of the time. I believe you could occupy it for 2 weeks a year, but if you occupy it for more than 2 weeks a year, now it's no longer a investment property. It's for personal use.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. I'm continuing my focus on real estate, and this week I'm talking about 1031 exchange rules and how it can help you defer capital gains taxes on the sale of rental property. And if you're considering selling an investment property or maybe multiple investment properties, then you definitely should listen, because you need to understand, first of all, what a 1031 exchange is and the very specific rules that apply to being able to use it. So number one, what is a 1031 exchange? Well, a 1031 exchange gets its name from Section 1031 of the U.S. Internal Revenue Code, which allows you to avoid paying capital gains taxes when you sell an investment property and reinvest the proceeds from the sale within a certain time limit in a property or properties of like kind and equal or greater value. And this could also be the sale of multiple properties that you're selling. It doesn't just have to be one, but roughly 250,000 1031 exchanges take place annually within the U.S., and the value is approaching $74 billion. Number two is, why consider a 1031 exchange? Well, one reason is that maybe you're seeking a property with better returns. Maybe the property that you own, you've realized has a low return, and there's another property out there that you can exchange into. And the benefit of doing it this way is that you'll now avoid paying taxes on making that exchange. Maybe you're also looking for someone else to manage the property. Maybe you've been managing multiple rental properties, single-family homes, maybe multifamily homes, and you don't want to deal with that anymore. Then this could be a reason to do that. Maybe you have single-family rental properties or multifamily, and you'd like to sell them and buy a larger apartment building that would make the management of your rental units a lot easier. Maybe you want to divide the properties for estate planning. Maybe you have one large property that you'd like to break up into 3 properties, one for each of your children. Another reason is you might want to reset the depreciation clock, meaning depending on the property that you own, there's a certain period of time where you can depreciate that property. And once you no longer can depreciate that property, that increases the taxes that you might have to pay on this property. So we'll talk more about this in a little bit, but that could be another reason as well. So number 3 is, what is a qualified intermediary? Well, the IRS, as part of the specific rules that they have to take advantage of a 1031 exchange, if you're doing what's known as a deferred exchange, which is the primary exchange that most people do, meaning that you sell one property and then you buy another, you cannot take receipt of the proceeds from that original sale. That money has to go to someone who's a qualified intermediary, and they are someone that receives and holds the proceeds from the property that you're selling while you determine the potential properties that you're considering buying to satisfy the requirements for the 1031 exchange. And if you receive the proceeds from the sale of this property, then you've most likely voided your ability to use this 1031 exchange. And these individuals or individual can have no relationship with the parties that are exchanging properties. And you want to be careful about choosing this person or this company, as this is a federally unregulated industry. So no federal requirements detailing how these individuals act. But however, because of some fraud that's taken place and also some bankruptcies of these companies that have happened and ruined people's chances of doing a 1031 exchange, several states have passed their own legislation requiring that these qualified intermediaries to abide by certain procedures. And those states are California, Colorado, Connecticut, Idaho, Maine, Nevada, Oregon, Virginia, and Washington. And these requirements, some of these states have licenses that these individuals need to attain. most of them require a notification if there's been a change in ownership or control. They also require that they maintain separate escrow accounts so that this money isn't just held on the company's balance sheet, that they maintain fidelity or surety bonds, and that they maintain errors and omission policies. So you can look into this yourself, and I would definitely advocate doing that because you don't want to be taken advantage of and either have your money stolen or have it tied up, and this then causes you not to be able to process the 1031 exchange. So the next thing I mentioned earlier is understanding depreciation and how it works. And if you're a real estate investor, chances are you're familiar with depreciation, but just in case you're not, that's the percent of the cost of an investment property that can be written off each year, recognizing the effects of wear and tear. And when a property is sold, your capital gains taxes are calculated based on what's known as the net property's net adjusted basis, which reflects the property's original purchase price plus capital improvements minus depreciation. And if a property sells for more than its depreciated value, then you have to recapture this depreciation. So this means the amount of the depreciation will be included in your taxable income from the sale of the property. And if you think about it, the longer that you hold a property, the more this will factor in. Because with residential rental properties, you can depreciate the cost of that acquisition when you buy the property minus the land value. Over 27 and a half years, you're able to write this off against the rents that you receive from the property. So let's just say you paid $200,000 to buy a rental property and the land is appraised at $50,000. That means that over the next 27 and a half years, you can write off this $150,000. With commercial rental properties, you can write that off over 39 years. So if you've owned residential rental properties for over 27 and a half years, you're no longer able to use depreciation. So this could be a reason to buy a new property because now you can write off the value of that property, against your rents, and that might help reduce the taxes that you're paying. For commercial properties, if you've owned them over 39 years, this could also be a reason to think about doing a 1031 exchange. The fifth thing to know is, what is a like-kind property? I mentioned before that the IRS allows you to take advantage of this if you sell one property and buy what's known as a like-kind property. And it's defined according to its nature, characteristics, and not its quality or grade. And this means there's a broad range of exchangeable real properties that you could buy. And so, for example, vacant land can be exchanged for a commercial building. Residential can be exchanged for commercial for residential. And industrial property can also be exchanged for residential. However, you can't exchange real estate for artwork or for stocks or for bonds because that doesn't meet the definition of like kind. And this property must also be held as an investment and not for personal use. So this means that you can't sell an investment property and then buy a residential vacation home if it's going to be used primarily by you. You'd need to be renting it out the majority of the time. I believe you could occupy it for 2 weeks a year, but if you occupy it for more than 2 weeks a year, now it's no longer a investment property. It's for personal use. And to receive the full benefit of the 1031 exchange, the property that you're replacing has to be of equal or greater value. So let's just say, for example, you're selling an investment property worth $500,000. You'd need to be buying other properties that you're exchanging into equal to at least $500,000. If those properties are worth less than that, then you have potential taxes that you're going to owe. The sixth thing is, what is the time frame to complete a 1031 exchange? So there's two important dates that you need to be aware of. The first is that within 45 days of the sale of the property, you must identify your potential replacement properties. And this identification must be in writing, signed by you, and delivered to a person involved in the exchange, like the seller of the replacement property or a qualified intermediary that you've hired. And something that the IRS notes is that you cannot provide notice to your attorney, real estate agent, accountant, or similar persons acting as your agent, as that is not sufficient. And then the second date you need to be aware of is that within 180 days of the sale of the property that you're taking advantage of this for, you have to complete the exchange of the new properties. And the only exception is in the case of presidentially declared disasters. So let's just say on January 1, is the date that you sell the property or properties that you're trying to defer the capital gain on, then 180 days later, you need to have closed on the acquisition of the property or properties that you're using for your 1031 exchange. The seventh thing to know is, how do you identify these potential exchange properties? We mentioned before that it has to be in writing, delivered 45 days to the qualified intermediary, but you have three different options as far as how you can identify these properties. The first is the 3-property rule, which allows you to identify 3 properties that you're thinking of buying regardless of their market value, so any 3. The second is known as the 200% rule, which allows you to identify unlimited replacement properties as long as their cumulative value doesn't exceed 200% of the value of the property sold. And the third option is what's known as the 95% rule, which allows you to identify as many properties as you would like, as long as you acquire properties valued at 95% of their total or more. So you have to use one of those 3. And another thing to note here is that normally you're selling one property, and then within that 180 days, you're then closing on another property or other properties. But there's something also called a reverse exchange, which is where you acquire the property that you're going to 1031 into before you actually sell the property that you're going to exchange out of. And this can be done. Obviously, you'd need to have the financing or the cash to do this. But in this case, you would transfer that property that you're acquiring into the qualified intermediary. And then within 45 days, you must identify that you're buying this property. And then within 180 days, you must need to complete the sale, just like before. The 8th thing to know is how to avoid paying unnecessary taxes due to what's known as boot. And this is where you do a like-kind exchange. And anytime you do that, as we mentioned before, the properties must be of similar or greater value. So let's just say that you're selling a property worth $500,000. If you then acquired, as I mentioned before, a property worth less than that, worth $300,000, then that difference is known as boot. That $200,000 would be taxable to you, and you would have to pay tax on that. So you want to be aware that the properties that you acquire need to be of greater value. And you also can be acquiring properties that have a mortgage. And this is especially important to note if you had a mortgage on your other property. And this is fine. You can acquire properties with a mortgage. And the requirement here is that the properties that you're acquiring must have a mortgage that's at least equal to the other property's mortgage. So let's just say you're selling a property worth $500,000 that you had a $100,000 mortgage on, and you're buying another property for $500,000. Well, that $500,000 property you're acquiring has to have a mortgage at least equal to $100,000. It's fine if that mortgage is $200,000 because it's greater. But if that property has no mortgage, then you now owe tax on that $100,000 mortgage. So when you're looking at properties you're buying, a lot of times because of this mortgage component, clients that I've worked with will acquire other real estate investment trusts if they no longer want to deal with the management of the properties. And when they do that, they need to find a real estate investment trust that has a mortgage equal to the mortgage that they had on their other property. Another option too is something called the Delaware Statutory Trust, which those are an alternative to a real estate investment trust. And those also many times can be found where they have a mortgage that is at least equal to the other mortgage that you had. There are expenses and fees that can be included in the transaction and can reduce your potential tax. And some of these expenses can be paid with exchange funds, such as broker's commissions, qualified intermediary fees, filing fees, related attorney fees, title insurance premiums, related tax advisor fees, finder fees, escrow fees. These can all be paid from the 1031 exchange funds. But expenses that cannot be paid are fees for financing, property taxes, repair and maintenance costs, and insurance premiums. These are not allowable expenses, and if they are used, that will also create taxable income. So the ninth thing to know is the different ownership structures that can be used to facilitate this 1031 exchange. And normally, 1031 exchanges are carried out by a single taxpayer or a husband and wife where they're selling their ownership in the property and then they're buying another property. But you could be in a situation where your property is owned by an LLC with other parties. And if that's the case, there's two options that are available to you if you'd like to sell this property and take advantage of this 1031 exchange. It can be a little complicated, but the basics of how it works are the same, depending on how your structure is. One option is called a drop and swap, and this is where one partner of the LLC wants to take advantage of this 1031 exchange when they sell the property, but the others do not. In this case, the partner would transfer their interest in the partnership in exchange for a deed to an equivalent percentage of the property. And then when the property is sold, the partner's share of the proceeds, the person who want to take advantage of this goes to the qualified intermediary, and the rest of the partners receive their money directly. Another option is where the majority of the partners want to take advantage of this, but there's one partner that does not. And this is known as a swap and drop. And if you're in a situation like this, it's most desirable to have the partner that does not want to go through with this relinquish their control of the partnership at least a year before the 1031 exchange. But if this is not possible, then what would be best is that the exchange takes place first, and then the partner that wants to get out exits the partnership in a reasonable amount of time after the exchange. Because if they try to exit beforehand, it can mess up how this is done. You can also use a structure known as tenants in common, where unrelated parties own interest, and this can be done up to 34 individual people in addition to you owning the interest in the property. So that's another option. The 10th thing to know is, what are the estate planning benefits of doing this? And I talked earlier about one of the main benefits is you're deferring the taxes on the capital gains that you'd normally pay when you sell your rental property. But an additional benefit that could be available to your heirs, and this may allow them to never pay capital gains tax. This capital gains tax would be completely wiped out. And this would be that if your heirs inherit the property through your death, they receive what's known as a step up in cost basis. And let's just say you invested $300,000 in this rental property, and you then 1031 exchange this into other properties, and then on your date of passing, the value is $1 million. So normally, if you were to sell this, you would have to pay capital gains tax. But that $1 million property becomes revalued as of your date of death, and let's just assume it's still worth $1 million. So if they sold it shortly after your passing, they would owe no tax. Or if they just wanted to hold on to it and continue to hold it as an investment property, they could do that. This is something that's definitely subject to change. The current administration is talking about eliminating this step up in basis. This not only applies to real estate, it applies to stocks and bonds as well. But if this stays intact, this is a way that you could pass on an asset to your heirs in a tax-free manner. So it's a reason why you might want to think about doing this 1031 exchange in the first place. If you're okay with just living off of the income that the property is producing and you don't need access to the principal, this is a great way that you can take advantage of this. So what are your next steps? Well, if you're considering doing this, definitely let your accountant know, as they are a very important part of this process. They might also have the name of a qualified intermediary to recommend to you. If they don't, then I would suggest beginning your search in one of those states that I mentioned that has some additional regulations. It doesn't mean that this is foolproof. You probably still could be taken advantage of, but these states do provide some safeguards, and also looking into those things that I mentioned before, as far as the company using a separate escrow account, having some type of fidelity or surety bond, also maintaining errors and omission insurance. These are all things that help protect you as a consumer. Next would be that once you decide on one of these companies, you want to hire them and make sure that they're hired before you sell the property. Because as I mentioned before, if you sell the property and you take possession of those proceeds, the cash from the sale, you've voided your ability to take advantage of this 1031 exchange. And then make sure you keep in mind those two dates. 45 days after the sale, you need to identify your potential properties. And then 180 days later, the closing on the new properties needs to have happened. And if you're someone who does things yourself and maybe you don't use an accountant, it could be a good time to think about hiring one. But if you're still going to do things on your own, you need to be aware of the form that you'll need to file with the IRS, which is Form 8824, which allows you to take advantage of this. So I hope you found this episode helpful on how a 1031 exchange can help you defer capital gains taxes. And if you're enjoying these podcasts, please make sure that you subscribe. If you're using Apple Podcasts to listen to them, make sure that you search Retire with Ryan and subscribe. You can also listen on Spotify, and you can also search Retire with Ryan and subscribe there as well. Hope that you have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.